Peace. What's happening, y'all? So look, if I was starting options trading with $1,000, my first goal would not be to flip the account. My first goal would be to survive long enough to actually learn how to trade. Most people come into options trading trying to turn 1,000 into 10,000 overnight, like quick. But that mindset is usually the same reason why people blow their account and lose all their bread. So in this video, I'm going to break down exactly how I approach options trading with the small account. That's the rules, the risk, the setups, and the mindset. So let's get to it.
This ain't lean, this is espresso off in my cup, I'm sipping. I've been up, if I ain't got it, you know I'm on the way to go get it. Ain't gotta flex, ain't gotta talk, they know this shit is different. Whole lot of comments while I talk, like, hold up, wait, let me finish my sentence. How you tryna play with a nigga that ball when y'all niggas on scrimmage? How you gonna talk?
So peace, what's happening, man? It's Ever Hardaway. Welcome to Juug the Market. On this channel, we focus on options trading, SPY, and SPX, pre-market prep, risk management, trading psychology, and building a disciplined trading process in public. This is not a signal channel. This is a process channel. So if you're trying to learn the market, play the market, and then judge the market with discipline, make sure you like, comment, and subscribe. Starting with $1,000 is not impossible to grow the account, but you have to understand what kind of account that you actually have. A $1,000 account is not a full-time income account. It's not a flex account. It's not a revenge trading account. It's a learning account. And with a small account, every little mistake is magnified because you have small buying power. The entries hurt more. Oversizing hurts more. Chasing hurts more. So not having a plan hurts more. So the goal is not to get rich quick with $1,000. The goal is to build the skill without destroying the account, and build it over time. So rule number one that I would start with $1,000 is what I would call the 10% rule. Now the 10% rule is essentially taking the 10% of that 1,000, and that's all I'm risking per trade. So that would be $100 per trade, which would give me 10 trades. That gives me 10 chances to make money. And that means I'm not putting my whole account into one trade. I'm only allowing myself to use up to 10% of the account on a single trade idea. A 10% of 1,000 would be 100. So that does not mean I'm willing to lose 100. It means the most I'm willing to put into a trade is $100. So I'm not trying to be big or risky with that. So keep it at 10%. So that gives you 10 chances. And then if you happen to make a mistake or lose that 100, you got $900 more. So, and then in order to even further minimize your risk, we go on to rule number 2, which is set a 20% stop loss on each trade. So with each trade like this on $1,000 account, entry is important. Entry is very important. Timing your entries are very, very, very important. You feel what I'm saying? Especially with a tight stop loss like 20%. So 20% of $100 is just $20. So that way, if the trade doesn't go your way and you got in at the correct time and everything, and it doesn't go your way, you only lose $20. So now you at $980. That's why I would set it at 20%. You gotta always keep in mind the stop loss is not there to hurt me. The stop loss is there to keep me in the game. You want to survive. So you want to give yourself more chances to hit that big one. You don't want to be out by day one and then you don't give yourself chances. There's been plenty of times where I've been upset because I didn't have money to trade with on a day where it would be prime for me to trade, on a day where my setups were showing up, on a day where I actually journaled and chose my plan and made a plan, and the plan worked out, but I didn't have the BP. So we want to survive in this. And just to clarify, this is why the numbers matter. A lot of people hear 10% think that means I'm risking 10% of the whole account, but that's not how I'm looking at it. I'm using 10% of the account as the trade size, then I'm using 20% as the stop loss on the trade. So on that 1,000, the trade size is 100. The stop loss or the actual loss is only $20. So if you do the math in the totality of that, I'm only risking about 2% of the total account, period. You feel what I'm saying? So that's the difference between having a plan and just gambling. Now let's go into rule number 3. Rule number 3 is to trade fewer setups. A small account doesn't need more trades. You need to hop in everything. You need better trades. You need great trades. You feel what I'm saying? With a $1,000 account, you want to hit a W on every trade that you're hitting, Whether it be a small gain or a big gain, you want to gain with every trade that you're hitting to grow this account. I would not be trying to take 5 trades a day. I would just be looking for one clean setup, get in, get out. And that's why I like sticking with SPY, SPX for larger traders, for larger accounts. But I like sticking with SPY and the indexes because you can read the market and see how shit is moving, see how you want to play the market to your advantage. So, man, it's a bigger edge. You're trading the overall market. You don't got to worry about an individual stock. The market doesn't owe me a trade a day. Some days you might not even trade at all because the setup might not come. This is teaching you not to force yourself to trade. This is teaching you to let the market come to you. The market is giving you data. From the time that bell opens, it's giving you data for you to trade until the time the bell rings and we're at the end of the day. So, and that's why I like waiting 30 minutes before I start trading after the market opens. But we're getting to that, you know what I'm saying? So, rule number 4, you want to build a pre-market plan. That's very essential. You don't want to start the day that bell ringing and you blindly shooting, trying to find things, you want to have a pre-market plan. Before I ever touch a contract, I need a pre-market plan. I want to know what kind of market that I'm walking into. You want to check the headlines, check the economic calendar, check earnings, check VIX, check SPY, check QQQ, mark key levels, prior days high and low, pre-market high and low, and possible support and resistance zones. You know, that's what you want to do in pre-market prep. And know we're going into pre-market prep that your plan does not have to predict the market perfectly. It just needs to prepare me for different scenarios that I see. So like example, if a price level breaks above a level and holds, I may be looking for calls. You know, if it rejects and then VIX is raising, I might be looking for puts. Or if nothing is clear, then I just do nothing. So if it's no plan, I don't trade. And that's the main thing, because trading blindly, easy way to blow up the port. And this is a $1,000 account. You can't play with this. Every trade counts. You feel what I'm saying? Rule number 5, wait till after open. I wait 30 minutes till after open. I wait 30 minutes until after open before I trade, you know? The only time I trade before 30 minutes is if I see a setup that I know is gonna pop. I see a setup, news, I see something in the atmosphere and in the environment, and I know that this is gonna pop. And even with those trades, I get in and get out. I get in, take my profit and get out. Because if something runs up real quick in the morning, it gotta be a hell of a news to keep it running. You feel what I'm saying? Or it has to be a hell of a catalyst for it to keep running up, you know? But yeah, I get in and get out if I do break this rule. But 9 times out of 10, I follow this rule, you know? The first 30 minutes can be dangerous, especially for small accounts, because one of the main things that the indexes do, and one of the main things you may see it popping, going to the upside, spot going to the upside. Oh shit. Right in the morning, you like, oh yeah, I gotta get in, man. You get that FOMO takes over you. Then you get in, then what it do? Tank back down. And now you done lost money within the first 5, 10, 15 minutes of the open. You had a whole day ahead of you. So at least wait for the first 30 minutes for all the smoke to clear, all the overnight orders. Make sure, you know, you wait for all that fluff to clear, especially on Mondays. Because Mondays you got weekend news, you got everything that's coming across from the weekend to now. So wait for the smoke to clear and wait for setups. Wait for direction sometimes. The first 30 minutes can either reveal the setup or expose the trap. I'd rather miss the first move than chase a fake move. And the first move is not always the real move. So wait the first 30 minutes after open. Rule number 6, focus on 1 or 2 products, you know? Do not trade everything. If I'm starting with $1,000, I'm not trying to trade every stock, every contract, every ticker, every headline. That's not what I'm trying to do. I want to focus on 1 to 2 products so I can learn how they move, learn their price action, and learn how they react to certain news, learn how they react to certain economic data being dropped. I want to learn their nature. I want to just learn that stock, per se, you know? The more things I try to watch, the more scattered my decision making becomes. And that's why I just try to stick with 1 or 2. I will focus on SPY and possibly SPX later. SPX is really high risk, high reward for people who are trading small accounts. But I will focus on SPY. Learn how SPY moves in its key levels because it's the overall market. Learn how VIX moves because VIX is the volatility index, but 9 times out of 10, 10 times out of 10, VIX does the opposite of what SPY does. Learn QQQ. Learn how contracts move at different times of the day. Learn the Greeks. Learn spreads, liquidity, and price behavior. Learn all these things in relation to 1 or 2 stocks that you may choose. Y'all may choose a small cap. You know, y'all may choose something that's, you know, an individual stock instead of an index. Whatever you choose, though, those are the things that you want to focus on. So, rule number 7. Let's get to rule number 7. Understand the contract before you buy it. The main reason why beginners lose is because they do not understand what they bought. A lot of beginner options traders buy calls and puts without understanding why the contract is moving or why it's not moving. They think if a stock goes up, the call automatically goes up, but it's not that simple. You gotta think about delta. Delta affects how much the contract moves. You gotta think about theta. Data eats away at premium. You see how much a contract is losing per day as much as you hold it, with data. Gamma can make contracts move fast depending on where it's at, Implied volatility. IV can expand or crush premium. When you see earnings, you might buy a call. It could be like far out the money. If it ain't really close to the money on earnings, sometimes you'll see it get IV crushed. You be like, damn, the stock went up, but why ain't my call going up? And that's because you got IV crushed. Because implied volatility before the earnings was way higher than it was after the earnings. So you gotta pay attention to that. Spread affects entry and exit too as well. Sometimes the spread may be so wide, you try to put an entry right in the middle, the price keeps jumping up or down on you. And that's because it might have low volume, or it's just a high spread and low volume to where it ain't too many buyers in the market, or it ain't too many sellers in that contract. So expiration matters also as well. You gotta get the right expiration. Make sure that the length of time is correct for whatever play that you're in to take effect, Also, strike selection matters. You want to get close to the money. With $1,000 in your account, you kind of want to make moves or get into stocks where you could get close to the money and know that the move is going to pop. You want to get close to the money, so you have the best opportunity to get deep in the money, especially when you feel real confident and have a lot of conviction about a stock and the stock movement or a stock price. So that's why strike selection matters. You could be far out the money and the joint boom and you got a call, but you so far out the money, it could boom $10 and you $20 out the money, so it don't really affect the contract, all because you thinking it's going to make this gigantic leap, and that's not the case. The main takeaway here is before I buy the contract, I need to understand what can kill the contract. So yeah, that's rule number 7. Now, rule number 8, journal every trade. Small accounts should produce data, not just emotions. If I'm starting with $1,000, every trade needs to teach me something. I would journal everything too. It really helps. So I would journal like, why did I enter? What was the setup? What was the market condition? Where was VIX? What was SPY doing? What was QQQ doing? What contract did I choose? Why did I choose that contract? What was my risk? Where did I exit? Did I follow my rules? What emotion did I feel? And what did I learn? The journal tells the truth. It shows whether I'm trading a system or just reacting emotionally. And I could tell this was an emotional trade right here. I could tell, damn, I lost money on this one, so I was trying to get back in the market and I lost more. Or I could say, hey, I got in at the right time, I just ain't exit at the right time. Or I entered at the wrong time, but I exited at the right time, still made profit. Either or, you want to be totally objective with this. If you can't be objective with yourself in trading, you're going to lose every time. You can't blame the market. You have to blame yourself. And sometimes there is going to be times where you were right, and then there's some news catalyst that just makes the market go the opposite way. That's how it happens. But regardless, you have to be totally objective with yourself in order to be the best trader that you can be. Because if you can't be objective with yourself or be real, it ain't going to get real. Rule number 9, right? Do not try to double the account every week. Unrealistic expectations destroy discipline. One of the worst goals for a small account is to try and double it every week. This might sound exciting, but it usually leads to oversized trades, bad entries, and emotional decisions. And then you get in the habit of making more emotional decisions than you do disciplined ones. Small wins matter. Any game. Some days you might make 200, some days you might make 20. As long as you came out of it with a gain, that's a gain. And that's something that you can learn from. Flat days are okay. If something's trading flat, like if there's some economic data that's being released the next day that's causing something to trade flat, it's okay. And that's why it's important to journal and look and see what's ahead for the week. So that way you can plan your trades. I'm not going to trade on this day because I know it's going to be flat. Or if you look back in your journal and you see on the days where before this economic data has dropped, you can see, okay, this is how I was moving on the last time I journaled when this happened. So you could gauge it better on this time. History often repeats itself. So your journal is kind of a way to keep track of your history individually. So you know if some things or some patterns were to occur again, you would know how to move in a better manner. Red days are survivable if risk is controlled. If you just control your risk, keeping that 20%, you're trying it, boom, you get stopped out. Let's say you take 3 trades, you get stopped out with that 20%, you just lost $60. You still have $940 left to trade with. You just got to stick to your rules and stick to that stop loss. So progress should be measured by discipline first. It should be measured by, did I make the right trade? Everybody wants to look at the money amount, the number, how much. When you need to be looking at, did I just make a successful trade? Did I win today? Did I gain something today? You always want to stay in the green. Did I gain today? Also, a successful day is, hey, I followed my rules today. I can live to see another day. When you follow your rules, that's the number one thing you can do with this account, because your rules are there in place for you to survive and keep growing. When you break your rules, that's when you lose capital. That's when you lose your buying power. And that's when you can't come back the next day to trade. So it's important to measure your discipline first. I follow all my rules. If I did, cool. That's a successful day for me. Not that I make money or not. Because when you do get to trading the big accounts, this is where the discipline is going to amplify. And you're going to see, okay, if I didn't train myself with this 1,000, I can't build with this 10,000. I can't build with this 100,000. I can't build with this M. So money is the result, but the process is the skill. And the process, when you build that process up and you master that process, the money is the byproduct. Simple as that. It falls right in your hands. So this is the framework, man. If I was starting with $1,000, this would be my framework. Treat it like a learning account. Follow the 10% rule. Use a 20% stop loss on every trade. Trade fewer setups. Build a pre-market plan. Wait after open. Wait about 30 minutes until after the open. Focus on 1 or 2 stocks or 1 or 2 products. Understand the options contract before buying it. Journal every trade and focus on process over profit. Using that framework, a $1,000 account does not need to be reckless. If I put $100 into a trade and stop out at 20%, then I'll lose 20. That is manageable. That gives me room to learn, review, and come back with a better decision. This is how I approach a $1,000 account. Not with hype, not with desperation, not with trying to force a flip, but with structure. So this is the foundation of Juug the Market. We're not chasing every move. We're not forcing trades. We're not trying to look exciting for the internet. We're learning how to prepare, wait, execute, manage risk, and review results. So this is how you start learning the market before you can try to play the market. If you're starting with a small account or you're trying to become more disciplined as an options trader, subscribe to Juug the Market, man. Subscribe to my channel. I'll be breaking down SPY, SPX, VIX, pre-market prep, trade recaps, wins, losses, and the lessons that come with building a real trading process. So drop a comment and let me know, if you would start with $1,000, what's the biggest thing that you struggle with? Is it patience, risk management, overtrading, or what is that? Leave me a comment. Let me know what's the biggest thing that you struggle with trading $1,000 if you were starting with 1,000. Small account does not need bigger risk. It needs better discipline, man. Learn the market, play the market, Juug the Market. Sarah Hardaway. Peace.